solution, David, in which they conceded, hey, we're not going to buy any more of these competing social networks, which I think would be kind of hard for them to buy one right now.
I think that's done. I mean, like you can even see that Google Fitbit. I mean, Fitbit is, what is it, a $1.2 or $3 billion acquisition? It's going to take almost 2 years to close. And Google's already making concessions, antitrust concessions to the EU for, this is a $1 trillion company trying to buy a $1 billion company. So I think large acquisition and M&A by the big four, it's impossible.
Is that good for society, Chamath, or bad for society? Is it good for our business of investing in startups, or is it bad for us investing in startups?
Well, I think it's good in one very important way, which is that it forces the capital markets to support these companies. And what I mean by that is, I've told you guys a couple times, but in the year 2000, there was 8,000 public companies. In the year 2020, July 2020, as we sit there, August 2020, there's about 4,000. So we've seen a shrinking of 50% of the number of public companies. So the idea that there isn't an M&A on-ramp anymore means that more capital and the capital markets will become more fluid, and we will support emerging growth companies in the public markets, is my suspicion.
If only there was an easy way for these companies to get public. Go ahead, David, respond.
Well, I think that, I think you're raising the right issue, which is the chilling effect on M&A that these hearings are going to have, even if Facebook is never broken up or that deal is sort of retroactively challenged. The big four tech companies have to be looking at these hearings, and now they're going to be second guessing every acquisition they want to make, and it's going to have a chilling effect. And I think that's a disaster for Silicon Valley, because we know that most of the startups don't work. And there's really only, most of them go out of business, and there's only two good exits. One is an IPO, the other is M&A. And if you take the M&A exit off the table because it's no longer sort of feasible from a regulatory standpoint, not all those companies are going to IPO.
Yeah, but David, what you're saying doesn't make logical sense, because if those companies are shit anyway, they should be going out of business. And who cares about an acqui-hire or some mini modest hire that gets you 2 times your money?
There's a lot of acquisitions where the acquirer is picking them up because they provide an important component or technology or product, but that startup would not have been a great standalone public company.
Would Yammer be worth more today, and would you be worth more money? Would your investors be worth more money if Yammer had SPAC'd? Yes or no, David?
The answer is absolutely yes.
Okay, so David, your argument makes no sense. I think you're playing to lose.
It's not that it doesn't make sense. I think David does bring up something that's important in the following way, which is there's a lot of companies, Jason, that get to a certain amount of scale, and then they basically start running out of oxygen, whether it's because they've overbuilt or they've overhired or they've overspent or
there's a natural audience for the product.
Yeah, maybe, but I think a lot of it is just sort of more overbuilding and just kind of distracted capital allocation. But then, you need somebody to come in. And this is the problem with Silicon Valley. And I think what David speaks to is the following. If big tech M&A is off the table, the single biggest thing that'll change is valuations by late stage privates. Because if you know that you can't get a 2x mark to market from the last post, guess what'll happen to your post money? It'll go way down, right? Because that was always the understood assumption. All these guys, these late stage money can come in and say, well, sure, I'll put, a $2.5 billion post, a $3 billion post, because in their mind, what they've been taught is that immediately sets the mark to get acquired as 2x. And in many ways, Facebook started it, because Facebook came to buy Instagram literally weeks after that growth stage round at 500 million. That's why they paid $1.1 billion.
They doubled the valuation. But wouldn't it be healthier, though, for the entire ecosystem if we weren't building those late stage companies to be flipped to a major company, maybe merging them with medium-sized companies or slightly stronger, and then taking them public, to your point, Chamath?
My point is, if you don't have a fucked up cap table, you can do all of those things. It's the fucked up cap tables
that solves that. Who needs this late stage capital coming in and doing these fakaka crazy rounds? Why not take the companies public earlier?
Well, because look, you don't always know what's going to happen. I mean, this is the reason why Instagram sold. It's the reason Yammer sold, is you don't know exactly what's going to happen. You don't know what the outcome's going to be. And in a lot of those cases that you're saying would become IPOs, if they weren't acquired. Well, a lot of them just, aren't going to work. It's crazy to be taking those exits off the table when both the startup and, the acquirer or the big tech company, want to do the transaction. And one of the reasons why I think these, there are a lot of these M&A type outcomes is because big companies have realized they're not very good at R&D, at sort of new product development. And so what they've done is they've outsourced a lot of their R&D budgets to M&A. And so they let the startups run the experiments, in any category. In any new area, you end up having a dozen of these startups get funded. We make fun of it because they're all, there's so many competitors in every little space, but those startups are the laboratory where all these experiments are taking place. And then, the big company comes in at the end and sees which experiment did well and they acquire it.
Friedberg, what do you think?
I think the advantage of being a platform business is you can plug something in and immediately gain a lot of scale from it. So, Instagram and YouTube are perfect examples. They were, reasonably fast growing, had millions of users. But once they were plugged into the engine of the bigger platform, they were worth 100 times as much over a few years because of all the usage and the infrastructure and the distribution, et cetera, that was provided. But it looked insane at the time to pay $1 billion and $1.6 billion for those two businesses. Each of them are easily worth 100 billion plus today, probably some multiple of that. And so I think it's Sacks' point is right. Is like I'd rather look. I worked in M&A at Google for a couple of years early in my career. I left Google in 2006, and a lot of the infrastructure that makes Google's revenue engine was acquired. We bought a company called Applied Semantics for $100 million or $100 something million at the time. Which ultimately became AdSense, and Applied Semantics could scan a web page and basically determine what keywords that web page represented, and then match ads from AdWords onto that web page. That acquisition was $100 million. I don't track anymore how much, but tens of billions of dollars of revenue are generated by that, by that AdSense system today.
You're bringing up something really important, which is at the time, Google was not a $1 trillion company. So the point is that Google had access to enough capital market scale where, nobody's going to get in the way of a $5, $10, $20 billion company trying to buy a $100 million business like that. I just don't think you're going to see, any regulatory body take that seriously.
Wait, so didn't we just paint the perfect picture, Chamath?
There'll be a trickle down.
Wait, isn't that the perfect picture?
No, in fact, I think what it means is the $20 billion company now probabilistically can actually win. So for example, like look at this Intuit Credit Karma transaction, right? The question is, could a smaller company have bought Credit Karma? Probably, but not at the price that, Intuit is willing to pay. Now, if Intuit gets big enough where there's a chilling effect and regulators say, okay, you're above a magic threshold and, no bueno on the M&A anymore. Now Credit Karma has two choices, which is maybe they sell for $4 billion to a very different company, right? Or maybe they sell, actually, let's take a different example. PayPal. PayPal is now a top 20 business in America, right? By market cap. So if PayPal isn't allowed, for example, to buy, a bunch of sort of like, payment companies, maybe what happens is like a medium tier business is allowed to buy them. And now all of a sudden those medium tier businesses can compete with PayPal.
That's what I think. That actually seems like the best solution that we've kind of stumbled on here. Can't Slack then become, or Dropbox or Uber or any Airbnb? Now they can become the acquirers of these companies and then they can compete. So why don't we just say, hey, if you're over $1 trillion or if you're over 500 billion, you can buy 1% of your market cap. I'm just throwing a number out here.
Jason, let me jump in on this. That's not what Nadler was arguing for. It's not like Nadler was saying that if you're a big four tech company, you can't do these deals, but everyone else can. The standard that Nadler and the precedent that he was essentially setting in that hearing is, 2020 hindsight bias. If a company acquires
but putting Nadler aside, I agree with you on that. But putting that aside, if we were going to come up with a rule, because we know the rules that as they currently exist are inadequate to do any type of regulation for these companies, because none of them have 95% market share. So if, in fact, we need a new solution, how about this for a solution? I'm just putting it out here. You can acquire something that is under 5% of your market cap. So if your market cap over the last year is $1 billion, you can buy something $50 billion or less. If you're under 500, if you're under 250 billion, you can buy whatever the hell you want.
But JK, let me ask this question. The points we made earlier about YouTube and Instagram, they were successful because of the scale of the user base of the platforms that acquired them and the work that had already been done. And so they could plug in. They would have
both been totally successful without
They would have been successful, but would they have been worth $300 billion like they are
maybe
today?
More.
It's unclear.
Maybe more.
But Instagram was 13 people. YouTube was a couple dozen people. It doesn't matter. The story is a small group were brought in with an interesting platform that was kind of working at the time. And then they became these $300 billion platforms. So that's one scenario. And a lot of money could be used, and Google and Facebook used a lot of money to be the best acquirer, to be able to acquire those businesses. And that's the argument for this. Hey, they're at such a scale right now, no one else can compete because only they can pay this fee. As Chamath points out with Intuit and Credit Karma, only Intuit can buy Credit Karma at that price. Now, the alternative way to think about this is, what if there is vertical expansion? So instead of leveraging their existing platform and their existing dominance, what if Google, in this case, is trying to get into the cloud business, right? And they're competing viciously with Amazon and Microsoft and others in this enterprise cloud business marketplace that is continuously evolving, changing every year. There's a different kind of lead and a different company that's suddenly growing faster than the others. And Google spent $2.6 billion to buy Looker. Buying Looker for $2.6 billion does not advantage Google's advertisers. It does not to some degree it might. It does not advantage Google's users. And it is not about platform dominance in their traditional ad business. It's about vertical expansion into a new market.
Okay, so here's how I'll rewrite the law, David. If you have over 70% market share in your vertical, you cannot make additional acquisitions in that vertical. If you have,
but they're buying into a new vertical, right? That's my point.
And so then the caveat is, if you're buying into a new vertical, you don't have to hit that cap.
We already have that. We already have. I mean, that's basically the way the rules work today. Is that you look at market share. I mean, Coke cannot buy Pepsi. Facebook cannot buy Twitter today. But what we're talking about is at a much earlier stage. Are you going to interfere with the M&A, or are you going to retroactively go back and unwind these transactions?
Unwinding transactions makes no sense. Yeah.
I think the point is, this is all water under the bridge, but the incremental M&A for these big guys is very unlikely. Now, David does bring up a good point. Unless it's in basically a do nothing, not that important, in the positioning category relative to the core business. And so this is why, it's, again, go back to why did Looker close faster than Fitbit? It's half the price. Looker is twice the price, right? Fitbit is half the price.
Yeah, new market completely. Yeah.
Yeah, and so there is a fear that there is going to be a compounding advantage that regulators have a responsibility to stop. So I think it goes back to once you get to a certain